So you want a low rate? That's fine. How bad do you want it? And is it really worth it? Let's talk about that. Hey guys, welcome to video 16. Today we're going to be talking about origination fees and lender credits and how they affect your interest rate and if that effect is worth the money. So we're going to jump right in. A couple things that I want to do first is I want to give some definitions. Just that way as we talk through this, you'll kind of know what I'm talking about. You'll hear me say market rate or par rate a couple times. That is the rate with no credits and no fees. It's just a standard. Here's your rate. Here's what the market is right now. Also, if you hear me talking about points, that's another word for fees. So that's basis points is what that is. So it's on a percentage basis for your loan amount. We'll get to that in just a minute. And then also credits. If I just say credits, that's obviously lender credits. So now that we've got some basic definitions in there, let's jump in and talk about what the points are, what the credits are, and if how to determine whether or not paying or buying down your rate, which we will define later, is worth it. All right, one key thing to remember here is that origination fees and lender credits are all based on a percentage of your loan amount. Most of the time, the top percentage you're gonna see is 1%. Normally they run around in the 1/4% to 0.5% range, but just so you'll know, it's different than your origination charges. And so if you remember back from a video that I did not long ago, I'll put the link to that video in this description, but I did a video on comparing apples to apples and how to compare different loan scenarios, apples to apples. One of those things that I talked about in there were origination charges. Now, I know that charges and fees seem like they're the same thing. Annoyingly, they are not. Charges are more of a flat fee for every loan. Origination fees are percentages of on a percentage basis of your loan amount. All right, let's talk about lender credits first. Lender credits are sometimes used to incentivize locking a rate or going with a rate that's slightly higher than market rate. And what they do is that let's just say that market rate or par rate, like I talked about before, is 4.5, and there's a 4.75 option, but with $1,000 lender credit or with a 0.5% lender credit. It's basically paying you a little bit more money at closing to take a higher rate. Lender credits are normally, but not always, used in a falling rate environment. What happens is consumers get that itch to buy, but they want to wait until the bottom of the market comes. And so sometimes lenders will incentivize those consumers and say, hey, I know rates are falling right now, but if you lock with me here, then I'll give you a 0.5% lender credit on this rate. And then that's how, a lot of times, that's when you mostly see lender credits being used. However, if it is a rising rate environment and you have someone that is very hypersensitive to their closing costs and they say, look, I need all the help I can get on my closing costs, I don't mind taking a higher rate for that closing cost, then you'll also see lender credits used there as well. Okay, now we've talked about lender credits, let's talk a little bit about origination fees or points. A lot of times what this is called, when you have an origination fee on a loan, it's called buying down your loan, because when you are charged a fee and you pay the lender for a lower rate, you're buying that rate. You're paying a certain fee for the rate that they're giving you. One big difference in origination fees or points and lender credits is a lot of times there's origination fees on your loan already when they give you a rate. So when you are looking at an LE or when you're looking at a fee sheet, make sure that you can look and see, are they charging me an origination fee already? Conversely to lender credits, most of the time you see origination fees in a rising rate environment, very similar to what we are now. You'll see people say, well, I know rates have gone up, but I really want that rate that I saw my buddy get 6 months ago, and so I'm willing to pay a little bit more money for that lower rate. Additionally, very similar to lender credits, if you have a borrower that is hypersensitive on their monthly payment and they say, you know what, I've got some cash to put down, I'm more than happy to pay a little bit more up front to get this monthly payment down to where I want it, that's when you'll also see lenders use those origination fees. All right, really quickly before we go, I want to try to do a little bit of math so that you can tell whether or not origination fee is worth paying for or not. Okay, so stick with me. I know this is going to be a lot of numbers, but I'm going to try to explain it as smoothly as possible. Okay, for this example, we're going to assume the market rate is 4.75%. Your loan amount's $200,000 on a 30-year amortization, making your monthly payment about $1,043. Okay, so that's where our baseline is for determining whether or not buying down the rate from 4.75 to 4.5 is where we're going to go. We're going to determine whether or not that's worth it with that scenario in mind. Okay, so like I said, your current par rate is 4.75. The lender says, you know what, I can get you 4.5% for 1% origination fee. So that's $2,000 on the $200,000 loan amount, and that payment on $200,000 at 4.5 instead of 4.75 is now $1,013. So used to be with 4.75, your payment was $1,043. Now with 4.5, everything else the same. Your payment's for $1,013. That's $30 difference. Now you had to pay $2,000 to get that $30 reduction in your monthly payment, okay? And so the way that you figure out whether or not origination fees are worth it or not is you say, okay, it took me $2,000 to get that $30 reduction. If I save $30, how long is it gonna take me months-wise to make up that $2,000? So you take the $2,000, divide it by 30, and in this case you get 66 months, in other words. So you get 5 years, 5.5 years. 5.5 years until you see any sort of savings from buying down that rate. That's not counting if you refinance anything or if you move. If you move before that, well then you just paid the $2,000 and you've lost money. So when you're looking at origination fee, that's the best way to decide whether or not it's worth it to pay for it. Okay, you take the total amount that it's going to cost you, divide it by the savings per month that lower rate's going to get you, and that's how you can decide whether or not it's worth moving forward or not. A good rule of thumb is that when you do that math, if the answer is less than 2 years, 2 years or less, I think that's worth buying down the rate. If it's more than 2 years, I don't think it's worth it. Okay guys, that's it for video 16. Thank you so much for sticking it out with me. I know the math there at the end kind of got a little hazy. I hope you're able to follow it. I'll do my best to write that as clearly as possible in the description and or comment section of this video, just so you can have that to reference, and also for you or for any of your clients that are trying to determine or decide what to do with an origination fee. Thank you again for watching. If you have any comments or questions, leave those below as well. I'll be happy to talk to you about those. Also, if I can do anything for you mortgage-wise, I'm always here. Please feel free to reach out. Would love to help you with your mortgage needs. That's video 16. Thank you guys so much. Have a great day, and we'll talk soon. Hey guys, welcome to video, let's see, 16?